Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Today on the podcast, we have Jeremy Roll. Jeremy was on podcast 95, which was 3 years ago, believe it or not, which is far too long.
Wow.
Jeremy, yeah.
Sorry.
Jeremy started investing in 2002 and left the corporate world in 2007 to become a full-time passive cash flow investor. Jeremy manages over 1,800 investors who seek passive managed cash flowing investments. He's the co-founder of FiBi, For Investors by Investors, which is a real estate meetup in California, which I love going to. Hey everyone, we have launched the BODC Multifamily Impact Fund. Invest with a trusted operator with a track record of success. Our fund offers diversification, risk mitigation, tax benefits, and stringent acquisition criteria. If you'd like to learn more, head over to our website at breakofdaycapital.com.
Choosing the right insurance coverage for multifamily properties isn't that complicated if you know who to talk to. At the Garzella Group, we're uniquely qualified to help you navigate the range of policy choices you have, and we're committed to saving you 30% in the process. We do intensive market research and have nationwide relationships, so we can find coverage other insurance brokers simply can't. We should talk. Go to quotenow.biz and we'll start the conversation.
So welcome, Jeremy. Can you start by telling the listeners a little bit more about yourself and what you do?
Yeah, and thanks again for having me on. And honestly, very sorry for breaking your train of thought there before. My name's Jeremy Roll. I'm located, used to be in LA for over 20 years, right near Gary, and I'm now down near Newport Beach in Southern California. I am originally from Montreal, grew up half my life there, spent about half my life in the US. Let's see. I have an MBA from the Wharton School. I was in the corporate world for over 10 years, working with some big companies. My last job before I left was Toyota headquarters in LA before I moved to Texas. I've been investing as a passive limited partner investor in syndication or managed opportunities since 2002. So it's now 23 years this month. But I've been doing it full time, almost 18 years. And essentially the cash flow got me out of the corporate world almost 18 years ago. And I tend to target kind of lower risk, more predictable, stabilized passive cash flow for predictability. So I'm invested in many different opportunities now. I've been in over 150 to 200 over the past 20 plus years. And I thank you for joining us here.
Yeah, thanks, Jeremy. So I'm going to jump right into it. It's been a tough road for real estate investors the last couple of years with flat to negative rent growth, higher interest rates for longer than most anticipated, and higher expenses. If you sold by mid 2022, you probably did really well, which we did. And if you bought in 2022, which we also did, you probably are suffering a little bit to a lot right now. I know you've been bearish for a while. Talk through some of the things that you saw were warning signs.
Yeah. So, all right. So, this is going to sound like I'm a Monday or armchair, whatever they call it, quarterback. I don't know what they call it, the expression, but this is what I was saying all along. So, I tend to spend like 2 to 3 plus hours a day, every day reading about economic news. And I try to avoid what I call like the landmines, in that when I'm an LP investor and I make an investment, I'm locked into an opportunity, typically that's illiquid for 5 to 10 years. I target longer term 10-year fixed rate loans. So when I saw two things happen in the early 2020s, it made me extremely paused and mostly on the sidelines. One was that we had a record long economic cycle at that point, and that's not disputable. It's just objective math. And so when you're in a record long economic cycle and you're breaking records there, you know that eventually it has to come to an end. That's just the way cycles work. Cycles have not died and gone. And so that told me that I had to be very careful at that timing. And most importantly, when you pair that with the floating rate bridge loan opportunities, which I saw, and there were just an enormous abundance of them, pretty much all of them were being done at negative leverage. So between the floating rate loans, which are at greatest risk to invest in at the end of a cycle, especially compared to the beginning of a cycle, combined with the length of the cycle we were seeing, and combined with negative leverage scenarios, which also means that the properties are heavily valued and investors weren't necessarily being compensated for the risk in terms of return. I mean, all of that together, I did not invest in any floating rate bridge loan deals. The only multifamily I did since, frankly, even 2017, being defensive going into what would have probably been a recession in 2020 had there not been a pandemic, just based on all the data. I had been investing only in low-income housing tax credit and tax abatement deals as kind of unique opportunities that were defensive plays, almost designed to not benefit from, but do better in a recession than a lot of other opportunities. And I'm just now waiting. And this is a very slow process. We can get into the timing and everything else, but it's real estate moves very slowly. And yes, it's been a really tough time for a lot of real estate investors the past few years, for sure.
Yeah, you potentially, we've known each other for a long time. Maybe got out earlier than the cycle, but the cycle was it had been going for so long.
Yeah.
But yet the gains that you would have gotten, you're probably way ahead than people that kept going and going like a drug and now are paying that price.
Yeah, and the truth is, I've never run the numbers, and it's very possible some people have done much, much better for me for taking that additional risk. That's totally possible. I still stand by what I did. So essentially, between 2017 and 2020, I lobbied my sponsors to sell based on cycle timing because we had an inverted yield curve, and that basically hinted at the highest probability of us having a recession in 2020 to 21. And so I actually was an over 30 exit between 2017 and 2020. Now, in retrospect, you could say that was early, and that was saved by massive money printing. Okay, that's all it was. All that's done is postponed a real recession. So in retrospect, I could have not sold and done very well. But if you ask me if I do it all the same again, absolutely yes, because the odds were in my favor, barring a pandemic and unbelievable money printing as a response. That would have been the correct move to do in retrospect. What's been frustrating for me is watching the artificial nature of money printing distort the market because I use history to try to help predict the future just to lower my risk. But you don't ever assume a pandemic and or an inordinate amount of money printing into that equation. So if you're trying to play it safe and do the right thing, and yet all this other distortion happens, now I've been sitting mostly on the sidelines since 2020, watching all this occur. It's 5 years later. And yes, I avoided getting hurt. Like I am not in any floating rate bridge loan deals. I am not in any foreclosures. I'm not in any, I'm trying to think. I think I'm in one opportunity that stopped distributing. It was mobile home parks. And that was a whole different situation. Nothing to do with the cycles. It was to do with some mismanagement. I'm in some stuff that's having lower distributions because of, as you touched upon, higher taxes, higher insurance, higher costs, inflation, and the headwinds we've had in terms of raising rents the past couple of years. But I'm not dealing with the type of challenges most people are dealing with because of the moves that I made. And it's also just a better fit for my personality. I'm just low risk, so I just sleep better at night. But trust me, this gets agonizing waiting years, right? But it's just the right thing to do. And thankfully, I have the cash flow and the diversified cash flow base to be able to wait. So,
yeah, I'm sure for us. So we've done 2 deals in like 27 months, and that's agonizing for us, But obviously, you're not going to do a deal just to do a deal. It just doesn't make any sense. It's the deals that you don't do are ones that kind of are look the best, not in your portfolio, but those are the moves that really help you get to where you want to get to.
Yeah, for sure. And, one thing that's been helpful for me is that I was on another podcast yesterday and, I've actually had the same box, so to speak, what I target. And it took me about 5 years to get it, or 5 to 7, 8 years to get it really, really nailed down. But I've used the same box, which is actually one of the things that also stopped me from investing, and that I look at a longer term fixed rate loan for predictability. So the short term bridge loans, regardless of cycle timing, probably weren't the right fit for me anyway. But that was just a personal thing, right? So sticking to that box and not getting enamored by all the profits at the time, which is very difficult to do. Warren Buffett's like a master at that, clearly. With that, if you can get the box right, get comfortable with it, and use discipline in the long run, I think it's just better for you because you're optimizing it, everything you're doing with your personality fit.
Yeah, when you have a system, a set of rules to live by or to invest by, you're much better off, because it's like when you create those and then you just keep changing them all the time, that's where you get burned. And so that discipline is incredibly commendable.
Yeah, and it's tough, and and I use the word. I don't use the word agonizing lightly. You probably don't either. Like, you definitely, after years of going through either very little or no transaction volume, it becomes truly agonizing. and I saw some data recently about why this particular recession is taking longer to occur than the average recession. And it's, by the way, if you look at the data, it's not even taken that much longer than average so far. Just the media would have you believe that, but that's not actually the fact. But they were saying, which I've never seen before, that a lot of jobs are tied to real estate and particularly building. At the end of a typical cycle, there's a lot of single family building that typically takes place. And we saw that in 2007 and 8, the most recent recession, obviously in spades. This time, what's happened is that there's been a lot less single family building, and a lot of the building has actually shifted to multifamily. And that's for multiple reasons, not the least of which is affordability, right? And the reality of the fact that we have more of a renter nation now because of affordability. Well, the timeline to build single family, putting where you and I live aside in California, is often 12 to 18 months, right? But the timeline to build multifamily is often 2 to 3 years. So what we haven't seen yet are the job losses, end of cycle job losses associated with the build. They're stopping to build because the reality is hitting them on, they just can't keep selling at the same price. We've seen severe discounting on the single family side to get rid of inventory, and inventory continues to go up on the builder side. So they're having a problem and a challenge. But on the multifamily side, we've only recently just seen tremendous deliveries in 2024, probably this year in 2025 as well. And I think what we're going to see is we're probably going to end up tipping into that recession, if not for another reason, because of the increase in unemployment that's going to arise from the building that's stopping now on the multifamily side. That's part of the delay, which is really fascinating.
And I assume built to rent is not considered in the single family, it's considered in multifamily, which has been a huge boom in the last few years, and there's tons more getting built.
Yeah, but I think the volume that's happening of that realistically compared to the entire housing stock is probably not enough to, let's say, stave off a recession, for example.
So what are some of your big wins the last couple of years? And that's, it could be the deals that you didn't invest in.
Yeah, well, the biggest win I have is the fact that I've not invested in a floating rate bridge loan apartment deal, and it's I don't even know what words to use to like describe watching everybody else who's dealing with these challenges. I feel awful. I frankly feel awful for the investors. I feel almost as awful for the sponsors who are having to deal with it. Everyone had their own strategies. I don't know. We can get into a whole long discussion, but the bottom line is I don't like people seeing people get hurt, and it's just like all around me, and it's horrible. And I just want that to be past everybody. But that is a win for me anyway. I do like 99% lower risk investing, but 1% is startup investing that I've done. And startups have done extremely well up until 2022, roughly, or 23. I've been able to cash out of a few of them that have been very, very good returns. Right now, I'm also in a position where I might be able to get out of one of them. And that'll be a huge win for me as well. And I think a lot of people assume I'm a perma bear, which is just not true because of what we discussed. It's like 5 years of artificially expansion because of money printing at this point. And but what people don't know is that I actually do better net worth by far if the economy just keeps going. I'm not looking for this to happen. I do want to know if it's going to happen or not, so I can either get back into the game or not. That's what's killing me. But I actually do much better numbers-wise if this keeps going because of that factor alone. So I've been able to take advantage of that as well.
So what is your outlook for real estate in 2025 and beyond with Trump in office? Are you a bull? Are you bearish?
So what's interesting about Trump is that, and I want to tell everybody, I don't vote. I just think most politicians are just in it for themselves, and lobbying and everything else. There's a lot of corruption. Everybody knows this already. So I'm not making a political statement here, but my opinion is that one of the challenges with Trump is that he's very difficult to forecast what he's going to do. He's very erratic. He changes his mind a lot. So that predictability I look for is really tough to have under him. You don't know if he's going to, he paused the tariffs recently on Canada and Mexico. Is he going to reinstate them or not? Because that has tremendous effects on multiple aspects of the economy, and frankly, it would also have tremendous effects on multiple aspects of investing in real estate. But we just don't know. So that's a challenge. On a positive side, he seems to be very pro-business. He's trying to get some tax cuts either permanently put in and or put through that would be helpful for us. Hopefully, we'll see some more depreciation or renewal depreciation benefits would be very helpful. But what I will say is this: if you analyze where we are in the economic cycle right now, looking at a lot of indicators have been used for 60, 70 plus years that have been either 100% perfectly spot on or almost 100% accurate. you'll see that at this stage where we are in the cycle and where we've come to with the inverted yield curve, leading economic indicators, et cetera, it's not really possible for a president to come in and reverse it. Like, we're already too far down the path, you know? Like, the track is ending and the train's about to derail, and he could slow it down maybe a little, but it's going to derail because he can't stop it. And that's just how the numbers work. And so I think a lot of people are very bullish on him being able to avoid a recession. And again, I want to remind everybody that we've already had a way long record economic cycle, and economic cycles probably aren't gone, unless you believe they are. I guess it's subjective until we see it happen, but it's coming. And I just think we're too far gone with how long we've had such high interest rates and the brakes that have been put onto the economy. I think that it's already too far gone. So I'm very bullish on, let's say, 2020, 6.5, 27, 28, and that he's very pro-business. And I focus on business and investing. But I think in the short term, I just can't see him being able to do enough quickly enough and impactfully enough. Even stimulus takes sometimes years to actually, trickle down into the economy. So that's kind of my high level take.
So I'm curious, do you think Jay Powell should be a lot more aggressive on cutting interest rates to help the job market, to create, more transactions and whatnot?
Yeah, I have to say that I think Powell is like dead set on looking at jobs, and I don't think that's necessarily wrong. And if you actually look at it objectively, what's happened is that we had actually a pretty significant increase in the jobs unemployment rate, which people are ignoring because we're only in the low fours, but we came from such a low place. There's already been quite a lot of unemployment increase. And, continued claims is continuing to be quite high. But we almost got to the tipping point, but didn't go past it. So we're like right at the balancing point where you're not quite like falling off, but you're just managing to continue to balance. So because of that, I think he's trying to take advantage of that window to continue to slow down the economy from an inflationary perspective, because to his credit, what you really don't want, which is what we had in the 70s and 80s, you don't want a resurgence of inflation again. And nobody wants that, right? So I think he's doing the right thing at the moment. It may not be the best thing for real estate investors who are waiting for rates to come down, but I think for the economy, I personally think he's doing the right thing right now. But I think that if you and I continue to watch the jobs very carefully, I have no doubt that if we go another 50 basis points increase in unemployment rate, you're going to start to see an aggressive reduction, because that is a pattern of what the Fed does. It's their playbook of what they do to try to stave off quote unquote inflation. They're always too late, but they follow the same rule book. And then, but knowing that, he's just following the same rule book. So, I'm not surprised by what he's doing, and I think he's following the rule book properly at the moment.
And I mean, I'm not an expert on any of this, but certainly with what they're doing now, as far as not hiring anyone for the government, and really cutting back, and the jobs report getting revised every single month, like I feel like we're going to get there fairly quickly, where they're going to have to start cutting.
Yeah, and it's hard to say for sure because it's taken longer than anyone would have thought so far. And again, if you look objectively, we should have had the average time we would have had a recession by, based on when the interest rate increases start to happen, would have been, I think it was June of 2024. So we're not that much further along from there at this point. We're recording this in February of 2025. And also, I don't know if you've noticed, but he offered early retirement packages that were elective or optional for people to take. And for the federal government, I don't know if it's the entire government, but in any event, I've been reading now that, the deadline is February 6th, a few days, actually a couple days. And they only have about 50,000 people, about 3 million people so far. It's not that many. So I don't know how much of an impact in the short term that's really going to have. 50,000 job losses, at one time is not insignificant, but it's almost like having 5 very large rounds of layoffs at one big Fortune 500 company, right? And maybe you can argue it's 2.5 instead of 5, but still. So we'll have to see what happens. I think the general philosophy of cutting the size and the payrolls of the government is definitely going to be slowing the economy down and potentially contributing to a recession potentially happening sooner or more quickly.
do you have an asset class you really like right now, or any class that you're like, hey, I'm running away from?
Yeah. So the one thing I still am okay with, as long as there's enough positive leverage, is a tax abatement type of structure. It has to be, there has to meet a lot of qualifications, but it creates a lot of positive leverage. It creates a lot of value added closing without any operational risk, really, except for complying with those requirements going forward. So I'm still open-minded to those. I'm not just randomly investing in all of them. I'm still being very picky and choosy with them. But here's what I'll say to everybody out there. Look, I'm one person's opinion. I could be completely wrong, but I'm going to ask the question like, if I were to say to you, okay, it's the beginning of 2007, what's a great asset class right now? And from what we know now, I would say probably nothing, right? Maybe treasuries. And so I'm currently in treasuries. I don't like those returns, but that's where I'm comfortable. And it would take an enormous amount of a situation to get me off the sidelines. That being said, there's always interesting opportunities out there. And you should always review everything because honestly, there are exceptions at some times. I mean, Gary, you look like you have a beautiful home, and I know you're in a very nice area. If you came to me and said, there's no loan on this house, I want 10% first position loan at 12% interest from you, I would almost certainly do it, right? Because that's a no-brainer. So things happen, and you should always keep your eyes open, but it would take an enormous situation for me to really be comfortable at this point.
What are a few key things a passive investor should do to get educated besides reading my book, Invest Smart? Shameless plug.
So you're talking about a brand new investor, correct?
Yeah, yeah. So someone's starting out, even like guys that people that have been doing it for even a couple of years, they still might not know like what are some basic stuff that they should be doing to help them become better passive
Yeah.
investors.
Okay. There's a few things that come to mind right away. So number one is please do yourself a favor because I see this happen all the time and I don't think it's good. If let's just say that I see people, they just exited a company, they have a certain amount of money and they just are dying to put it to use to make cash flow from it, right? And I get the concept. The first thing I'll say to them or ask them is, have you considered where we are in the economic cycle and at least formulated an opinion about whether this is the right time? Because if you came to me in January of 2007 and had that scenario, I would tell you to think hard before you did anything, right? So just because you have the capital today doesn't mean it's the right timing. So make sure you formulated your own opinion about timing to make sure you agree it's the right time to do it because just because it's a good time for you, it doesn't mean it's a good time for the market, right? So that's number one, very important. And educate yourself on that and read up on that. Number two is if you're brand new or you're trying to figure the space out, I always tell people to try to focus on one asset class first, learn that as much as you can, and then give it a try. I see a lot of people get confused or almost like paralysis by analysis, looking at all different asset classes. And it is a great world here, and there are a lot of options. But I always tell people that whatever asset class you're most comfortable with. So if you grew up living in a mobile home park, go research mobile home parks. You'll understand it better than most people. You'll have an advantage going into it. A lot of people choose apartments for two reasons. One is because they've lived in them before and they understand how they work. And two is because they're probably the most plentiful volume of opportunities you can find. Because if you think about it, in an average large city, there's more apartment buildings than anything, right? Any other asset class. So, but just choose one, learn it, dip your toe in that a few times, learn from that. And then you can apply like 80 or 90% of the basic foundation to the next, any other asset class, and then just tweak the differences, right? It's the underlying revenues, expenses, occupancy, vacancy, rent assumption and growth, expense assumption growth, and all these other things you learn that apply across everything. So that's something I strongly recommend is focus on one thing first. And then just high level, as you mentioned, it's always good to read some quality books like Gary's book. And there's now online communities that could be extremely helpful to you. And even if you've been doing this several years, but you haven't tapped into them, I strongly recommend them. And that includes online communities as well as potentially some either virtual or in-person conferences can be very helpful as well.
Yeah, great advice. I love market timing, focus. I see so many investors dabble here, dabble there, without any focus and any level of expertise because you can if you're just chasing so many different squirrels, and then being a part of a group too. And that's a mistake that I made in the beginning too when I started investing. I didn't have a community of people to go and share like, hey, have you invested with this person? Or just for the learning to be around how they look at things is incredibly valuable.
Yeah, and it's a whole different world today than when I started in 2002 with information sharing. And that can save you a lot of headache and help you a ton and also accelerate your learning timeline.
Absolutely. What are one or two tools? It could be something, one of the things you read every morning that you swear by to help you be a better investor.
Yeah. So I try to get a mixture of mainstream media and non-mainstream media because I just try to get into the data as opposed to like getting out of the weeds of whatever the headlines are. They're sometimes, purposely put there. So a couple of things that are very interesting to read that some people may not have heard of. So one is calculatedriskblog.com. I really like them because they just publish graphs and charts on today's economic data and with very little commentary. So they're slightly positively biased, I think, but just very slightly. And they almost publish no summary of it, just written. So, but one great thing they do is they create their own charts. And so if you want to take a look at the jobs report, yesterday, then you can look at the chart and you'll be able to look at it for 20, 30, 40 years where it's not so easy to find that, right? So that's a really good place in a repository to go look at things. They also tend to focus on some data that the mainstream media doesn't publish that can also be helpful, like trucking volume and other things that can give you even more insight to what's really going on in the economy. The other one that's kind of interesting, if you've never went to it, is shadowstats.com, because shadow stats, for those of you who've never heard of it, is, for example, for inflation, the government has changed the way it calculates CPI more than 20 times since 1982, and it continues to do so. The last time it changed it, I think, was last year, actually. And so that continues to evolve. And in some ways, that's probably good to reflect what we're buying in modern society. But in some ways, you can argue that they're manipulating the data. And frankly, I believe it's probably a combination of both. And so if you want to see what the real inflation is, quote unquote, from pre-1982 calculations, they will publish that. You will be shocked at the difference because the media will say that we never got as high in inflation as we did in the 70s. Well, what happens if you actually adjust that for the way they calculated in the 70s? We were almost there. Almost. They're just hiding that reality. Shadow stats helps you to uncover a little bit more of that reality. And most importantly, as an investor, if you kind of decide that a certain way of calculating it is the more correct way that you believe, then you know what you're trying to keep up with in terms of cost of living and inflation when you're looking at target returns and the true numbers as opposed to the numbers that are published if you think that there's a variance between them.
Well, excellent tools. Definitely check them out. Jeremy, thanks so much for coming on and sharing your wisdom on passive investing. Where can listeners connect with you?
Yeah, and hopefully this was helpful for everybody. So best way to reach me is my email. You're welcome to reach out, honestly, if you want to network, you're new and I can help you in any way, whatever it is. My email is jroll, so JROLL at Roll Investments, ROLL Investments with an S.com. So jroll at rollinvestments.com.
Awesome. Thank you again so much. This is Gary Lipsky signing off. I'll see you next week on the Real Estate Investor Podcast.
Thanks, everyone.
To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and like, subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.